Hi everybody, welcome to our DAT IQ Weekly Market Update. This is our update for the 8th of April, episode 334. I'm Dean Croke, Market Analyst here at DAT, along with co-host Chad Kennedy. Guest Jason Miller may be joining us a little bit later, depending on his schedule. It's been a big news week, so hopefully we'll have him on. How's things, Chad?
Yeah, things are good. Central Florida is just calming down after Strawberry Festival. Sun and Fun just wrapped up, which is one of the nation's largest fly-ins. We got produce season peaking, so hopefully I-4 traffic calms down a little bit. I was just looking it up. Between Strawberry Festival and Sun and Fun, we draw about 1 million visitors to Central Florida, and I-4 gets pretty congested. So hopefully drivers will get a little relief here soon.
Yeah, the 75 Chrome Shop Truck Show in Wildwood is on shortly. All of the big shiny refrigerated trucks will be off the road for that week. So capacity usually tightens. I like to draw a direct connection between the two, having been to that truck show. It's quite the big one. I noticed that the big flower companies, trucking companies have got their surcharges coming in late April for Mother's Day. So that's starting in a couple of weeks. So we're starting to get into that produce season bump that starts out of Florida, which is good news.
Yeah, I think once watermelons pick up, they take up a lot of space. That'll kind of enter the peak.
Yeah. All right. Let's dive into the market update. Some of the key trends we're watching, the market continues to tighten in terms of capacity, flatbed also especially, but rates did start to cool at the end of last week as the 7-day rolling average data started to move further away from the end of month increase at the end of March. So signs that flatbed may be cooling. A lot of volatility around the border in terms of impact of tariffs. Mexico produce was surging ahead of last week's tariff announcement. Reefer load posts were up 22% in McAllen last week. Volumes out of Mexico produce were up about 19% week over week, mainly through the McAllen market. It wasn't until last Wednesday that the Mexican government found out that produce wouldn't be subject to tariffs. So we saw a lot of import volume coming across, not sure about whether they'd be subject to tariffs or not. Some news out last week, the ISM PMI contracted for 2 months in a row now. The LMI came out, it was down to 57.1. That's the lowest reading since August of 2024. Spot market capacity turned positive for the first time since October 2025. That's as we measure it by the number of exits subtracted by the number of entrants. It was net positive after 2.5 years of net carrier reductions in the market. This week's market update that'll be out this evening at dat.com/market update. We're looking at ATA tonnage index, which was down slightly. The Vidalia onion pack date has been announced, the official date for the 2025 produce season, officially the starting line in the spot market world, and more on the ISM PMI. Let's start with load to truck ratio in dry van. Load post volumes were up for the third week. Load to truck ratio ended the week up 14% at 5.77. In refrigerated, load post volumes also up, boosted by the increase in produce that we just spoke about. North American volumes were up 19% week over week, mainly due to the Mexican push. Load to truck ratio in the refrigerated market was up 26% last week to 10.31. That's about double what it was this time last year. And in flatbed, after increasing for 10 weeks, flatbed load post volumes reversed course last week, indicating that we may be seeing some cooling in that market. Volumes are down 2%, load to truck ratio down 3% to 46.82. Let's have a look at the year over year. Look at spot rates. Dry van rates up 2 cents a mile last week. National average paid carriers $1.66 per mile. Volumes were down 2%. Last week, though, which is not unusual given the push at the end of month, end of quarter in the prior week's data at $1.66 per mile. Line haul rates are about 8 cents a mile higher than last year and 10 cents a mile higher than where they were in 2019. On our top 50 lanes, rates averaged $1.94 per mile last week, up 3 cents. That's about 28 cents a mile higher than the national average. And in our Midwest bellwether states, which have the highest correlation to the national average, outbound spot rates up 4 cents a mile on a 2% lower volume of loads moved. Carriers were paid in the Midwest an average of $1.89. That's 23 cents a mile higher than the 7-day rolling average. All right, having a look at refrigerated market. After being flat for most of March, available reefer capacity tightened slightly, pushing up line haul rates by a penny per mile last week to $1.90. Volumes were flat, though, nationally, Reefer spot rates, excluding fuel, about 2 cents a mile higher than last year. And in flatbed, spot rates have now recorded 8 weeks of gains following last week's 4 cent per mile increase at $2.19 per mile. Line haul rates are about 18 cents per mile, or 9% higher than last year. Let's go to our short-term forecasts. These are our ratecast forecasts going out 35 days. They heavily weight long-term seasonal trends. The forecast is bounded by an upper and lower forward-looking error bands in yellow and red. And the blue line, of course, is the rolling 7-day weighted average. And green is the 35-day ratecast forecast. Remember, these are line haul only, excluding fuel for loads over 550 miles. Let's start with dry van. Dry van saw an improvement in the model that I ran on Sunday compared to the one prior. That spanned month end over the 29th and 30th. So it may have been some volatility that market forecast was looking at. This week's forecast has improved. Ratecast is expecting rates down 4 cents per mile to $1.62 by May 9. That'll make them about 7 cents per mile lower than where they were last year. In refrigeration, seasonal Mother's Day shipping and early produce volumes are coming into the early May forecast, where Ratecast expects rates to bottom out around $1.76, excluding fuel, at the end of April, before the produce season inflection begins, ending the 35-day forecast range at May 9 at $1.90. That'll be about 10 cents per mile lower than where it was in 2024. In flatbed, Ratecast expects rates flat out to May 9, dropping 2 to 3 cents by the end of April before picking up again in early May, ending the 35-day range forecast at $2.21. That'll be 24 cents per mile higher than last year and about 15 cents per mile lower than where it was in 2018. Quite extraordinary numbers there in flatbed to start the year. Okay, Chad, that's the spot market. Over to you for a look at the contract market.
Thanks, Dean. As a reminder for the audience, everything that Dean just covered was from a broker to a carrier spot perspective, and this is from a shipper buy perspective. So we're looking at contract rates and shipper spot rates and the relationship between the two. This first graph goes back to 2016. It's a weekly graph. Spot premium ratio in yellow at the top measures the premium for spot rates compared to contract rates. We're looking at nearly a one-year low there at negative 13%. So we've got a unique situation right now where contract rates are on a very slight incline up and spot rates are just at a low right now. This metric here, the spot premium ratio, at the lowest since May 2024. If it goes much lower, we'll be looking at potentially an 18-month low. New rate differential at positive 1.2%. You can see we've been bouncing around 1% for the better part of the year. Year to date, and contract rates very slight incline up, as you can see there in the contract rate index in purple. On to refrigerated, negative 12.8% for the spot premium ratio. We're looking back to May 2024 again for a low since May 2024 on spot premium ratio. Not good news for carriers or brokers. Still continued decent news for shippers. On the new rate differential, a blip there, negative 0.5%. So we'll see if that holds as more data comes in for that particular week. And contract rate index pretty flat there over the last few weeks. And then finally, the three metrics, dry van, temp control, and flatbed stacked on each other. Spot rates in yellow there and contract rates in blue. You can see that relationship between the two. That spot premium ratio is the difference between the yellow line and the blue line. And on dry van there, you can see that recent separation, slight upward movement on the contract rates per mile, while spot rates are going down, and pretty extreme there on the temp control side. A little bit of relief on the flatbed side. I think, Dean, you've been predicting that for a few weeks, and I think shippers are starting to feel it a little bit. So that's a wrap on contract rates.
Yeah, it's interesting. There was some early talk that the flatbed market was going to replicate what we saw in 2018, which was, of course, a bull market for flatbed carriers in particular. Also on the strength of where we were coming out of a strong industrial economy in 2017. Parallels we can't draw with the current year. So that's why I've been a little bit hesitant to call this year's trend in flatbed something that's longer term. There's a weakening in load posts last week. Rates are starting to cool a little bit. So I think they'll be flat, and I suspect we've seen our typical first half gains in flatbed already, and rates will start to flatten out from here. That's what it feels like. Of course, that's given all the uncertainty and assuming that things hold the same. We don't know if things are going to fall apart based on where the markets are heading during all the tariff uncertainty. Chad, question on replacement rates for those that are sort of new to the show and not following things like bid season and how rates enter routing guides. Talk through a little bit about how the bid process works and how rates come into routing guides, and then how shippers look at the number one carrier and the number two carrier, the number three carrier, as they accept or reject loads that come in through their tender systems.
Yeah, sure. I'll make some generalizations. Not every shipper follows this policy, but many of our large enterprise shippers will enter into bid preparation season in the fall, preparing the data, getting the data ready, and sending it out to the carriers. And that might be through a large RFP type system that they receive those bids in. Some of them still send them out via spreadsheets as well, via email. And so there's a little bit of back and forth in that process. Round one, round two, do you want to sharpen your pencil? Last call, round three. And then shippers go through another phase of analytics, analyzing how they want to make their awards. And they take a lot of things into consideration, service being one of those top things, not just cost. They will rank everything by lowest cost, and then they'll start to put some rules in place. Maybe my top performing carriers, move them up in rank. They'll also put some constraints into the analysis, and it gets quite complex if you think about a large enterprise shipper sending out maybe 2,000 lanes to 200 to 300 carriers. You're getting a lot of rates back, a lot of data back, and then they'll throw a constraint in place. For example, maybe don't displace more than 70% of my incumbents because they don't want to disrupt their network too much, especially if you have a lot of drop trailers in place with these larger shippers on consistent lanes where the contract activity is. So a lot of this is drop trailer. So once they go through those types of analytics and they've got their award, the output of the bid is they'll make their awards, get those commitments on volume and rate. I know Chris Kaplis likes to say a lot that these so-called contract rates are binding in rate, but not binding in volume. There is a bit of a volume commitment made there. There's no real significant immediate, at least, penalties if volumes aren't met on those. So those commitments are made, awards are made, and now we're into like December, January at this point, and we're planning to start these lanes in March, April. Prepare your equipment and that sort of thing. So if it's a drop trailer lane and they need to get 10 trailers into place, they'll start that process ahead of time a little bit. So right now is the time when a lot of that bid award activity actually starts. So the output of that RFP is a routing guide plan. That routing guide is that ranked order of tenders that a shipper will roll through. So it's that top committed carrier that committed to 15 of my 20 loads per week with the lowest cost and all my other constraints considered. They're going to get first tender for those first 15 loads. And then after that, it's going to go down to the tier 2 carrier, then the tier 3. And that tier 1 might reject for some reason any given week and only take 10 loads. Maybe they're out of capacity. So then those loads roll down to that tier 2. Less acceptance at that tier 2 level. I think overall, shippers are expecting around 85, maybe right now closer to 95% tender acceptance to that primary award. Yep. But that leakage there as you go down through the routing guide, that is routing guide leakage. And that's that tender rejection that shippers expect. So, it's interesting right now as we monitor that new rate differential and we see that popping up. There's more volume going into that metric. Maybe I'll try to bring that stat in next week on where we're at on that volume and that metric.
Yeah.
But,
Is it fair to say that when you look at the world in the, from a rate perspective, that the contract market is more exposed to drop and hook, trailer pools, and spot market is more live load? Is that how you look at the difference between the two?
Yeah, definitely. In broad brush strokes, you're typically looking at your major asset players or at least medium-sized asset-based carriers handling that contract drop trailer freight. And then from a large shipper perspective, you're typically looking at so you might have 100 asset-based carriers in your network, and then maybe 10 brokers in your network to access the smaller carriers that are more of your, probably preferring longer haul, live load, loads and spot activity.
Right.
And I know a lot of shippers will connect to some of those brokers via API. And I've talked to a lot of them about this. They do limit that to that live load freight. That's right.
It's very interesting. You know, we tend to overlook that in the spot market because the rates are higher typically when the market tightens. But I think a lot of people forget you've got a lot of live loads, a lot of accessorials, a lot of time on loading docks. It's also why you see flatbed spot rates up in the 30 to 35% range of loads moved. It's such a big part of the flatbed market.
Yeah, that's right. Yeah. One of the hardest things to cover, and I can speak from experience, is that drop trailer load that's in the spot market. Nobody wants to position an asset to run that one load to go back and get the asset later. It costs twice as much.
I was reading Zach Strickland's chart of the week on FreightWaves this week. Zach's one of the top analysts in the country. And I was sort of looking for some data points on what the impact of tariffs might be. The outbound tender volume index was down 9% year over year, which is significant at the start of April, where volumes typically start to pick up. Tender rejections, you mentioned, are sort of historically low at in that sort of 5 to 6% range for dry van. So that's become a feature of the market where we're seeing historically high acceptance levels. Do you have a sense of why that might be? And I'll sort of preface that with my theory, and that is that we heard from our shippers that they were sending a lot of those low volume lanes that had a high propensity to failure because they were low volume and the large carrier couldn't accept them. If they carve them out of the RFP, then by default, you'll have less loads in the mix to be rejected in the first place.
Yeah, I think, when I started out as a carrier, more years than I'd like to admit ago, but it's around 20 years ago now, asset-based carriers were more active in the spot market. And when I was at a shipper in the early 2010s, we could get a lot of freight covered by asset-based carriers. But that has shifted over the 2010s into the 2020s. It is very difficult to get an asset-based carrier. Asset-based carriers have moved more and more of their capacity intentionally into dedicated. And if they can't get dedicated, they want consistent freight. At least that I need 26 weeks out of the year movement on this lane. So that's, and that makes a lot of sense. Asset utilization, and they're very asset intensive businesses, and they're trying to get those drop trailers in place to utilize those drivers' hours as best as they can. So the shorter haul drop trailer, as many turns as they can get per day. So shippers have become more tuned into, and with better data analytics, segmenting their bids and taking that freight that runs maybe less than 26 or maybe 13 weeks out of the bid, where we used to just include it. We'll take it out of the bid and then plan for that to be in spot and give the brokers some information about that. That I know these are spot, they may not repeat, but this is what my spot activity has looked like in the past, so that they can kind of get a frame of reference to prepare. So
how much do you attribute things like our benchmark IQ to that, like that giving them the ability to make that decision?
Yeah, it's a huge component of it. Being able to segment the data by lane frequency, right? Like that's a simple example, but we have an algorithm that runs in the back of Benchmark IQ that segments data by number of weeks that a lane has run. And you can measure your performance to the benchmark rate by those segments. And you can clearly see in a tight market, those infrequent lanes you're going to pay a large premium on. And then you can procure a much smarter when you're segmenting your data that way.
Yeah, I have to think the rejection rate is being impacted by that strategy as opposed to net changes in capacity. Yeah, there was a time when the tender reject index was a really strong correlation to spot rates, and I'm not saying it's not, but I just wonder about how much this is starting to change our market structurally.
Yeah, it'll be interesting too over the next year or two when we finally hit a tight market at some point, Dean, to see, like, there's been a lot of employees that haven't experienced a tight market that are in seats, at shippers and at brokers and at carriers. That frontline logistics coordinator position may not have seen a tight market, and so they'll learn a lot. And they'll cut their teeth through that. And,
29 months of if you joined the market within the last 3 years, it's probably been all down.
Yes,
it's been easy experience.
Yeah.
So. Chad, I always learn something when I talk to you. That is very illuminating. I hope a lot of other people picked up something from it. All right, let's wrap up our show. A couple of call outs. Next week's show, Tim DeNoyer, Vice President over at ACT Research, will be talking about long-term forecasts, new truck and trailer orders, and what that means, and how the current administration might be impacting his projections. Professor Kaplis, Freight Find podcast, he's talking to our very own Vice President, General Manager Carrie Jablonski, formerly head of Trucker Tools, about the acquisition and some of her insights on the freight market. Don't forget, Roadcheck Week is coming up May 13 to 15. That's going to be pivotal again this year. It'll be interesting to see whether carriers take time off or keep rolling. Make sure you set up alerts for our live shows. Subscribe to our channel on YouTube and LinkedIn. And with that, another show is in the books. Thanks for watching, folks. Be safe. Be nice to everyone. We'll be back here again next week at 10 a.m. Eastern, 7 a.m. Pacific.